Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, we are going to talk about mortgage demand, which has dropped to the lowest level since 1996 as interest rates head toward 8%.
Which is really not fair because the last time they were this was like 2000. So interest rates at 1990 or demand at 1996
We're going to get there,
levels.
Juana.
But,
We're going to get there. Okay.
Sorry.
What we're going to do is we're going to prove to you that this has almost nothing to do with interest rates. And you're going to go, but Todd, it makes sense that if the rate goes up, the demand should drop because it's more expensive. So people are going to lose. There's no way you could prove it. Guys, I'm going to prove it to you. Okay? We're going to do it. So we're going to go through the article. We're going to talk about the talking points. I'm going to show you the chart. And then we're going to explain. And then you're going to go, oh my God, these guys are super smart. Well, she is. She's super smart. Okay.
So I'm super smart and you're the guy. So together we're the guys. Got it.
We're the guys. We're like the guys. Okay. All right. We have a diverse show. We have male and female, right?
You identify as such?
I identify as such.
Have you picked which one you identify as?
Pretty much. Back when I was in the Marine Corps, we did not, it was pretty obvious who male and females were. We could actually do that without having a degree in biology. So, okay. They actually had different PFTs. The women didn't have to do pull-ups. We had to do 20 pull-ups. The women had to do a flexed arm hang. They just had to hang on the bar. And they would help them up. And then they just had to hang there for a certain amount of time. It was kind of cheesy, actually. Okay, we're going to go through the article, and then we're going to show the chart.
I could say so many things, but I'm not going to.
Yeah. All right, here we go. So here's the first thing from the article. The average contract interest rate for 30-year fixed-rate mortgages with conforming loan balances, which is 726 or less. This is Fannie Freddie rates. Remember, these are the highest rates that you can possibly find, okay? Increased to 7.53% from 7.41%. Now, before you run out Google rates and post them, oh my God, Todd, it's 7.78%, right? These are contract rates. These were the rates that were locked. Why is there's advertised rates and then there's the rates people get? First of all, let's get rid of this thing where people keep posting the offered rates because that's not what people are locking. Why is that?
So look, think of it this way. Think of it as the advertised price for a used car. Yeah, well, not really, right? It's negotiable. So in this case, interest rates are negotiable, but they're negotiable based on several things. First of all, competition amongst lenders. Then they're also negotiable based on how much down payment you're putting down, what your credit score is, what your debt to income ratio is. So it's a whole host of things that influence the actual rate that you would get on a mortgage. So you could apply for a mortgage. I could apply for a mortgage. We could do it simultaneously with the same lender, and we would get different rates because whatever our differences are would account for that difference.
Also, remember, some of the advertised rates are over 8% because people have bad credit scores. Remember, this is Fannie Freddie, so this is all the FHFA, that matrix, right? So you have a really bad credit score, which means your interest rates are higher. And then you just say, oh, that's being advertised, but I can't afford that, so I'm not going to buy a house. And then some other person who's advertised a lower rate because they have a better credit, they're the ones that actually go buy the house. So the contract rate is what we're talking about. 7.53% is what it is. So it's about 0.5% away from
right. So when Todd says the contract rate, think of it as the actual rate that somebody is paying, not the advertised rate. Okay, this is what's actually being bound.
Think of list price of a home versus sale price. Okay, just because your neighbor listed his house for $1 million does not mean your $250,000 house is now worth $1 million. Say it's what it sells for. Okay, applications for a mortgage to purchase a home fell 6% for the week and were 22% lower than the same week 1 year ago. What is the biggest reason why this is? Why is it 22? First of all, week over week, it fell 6%. Why is that?
So first of all, it fell probably also because inventory is lacking.
Okay.
Not a whole lot of homes are coming on the market because we're getting that time of year where people are that have not put their home on the market yet are less likely to do so. So that's part of it. Another part, of course, is that interest rates have gone up. So that has, again, shaved off a portion of the buyer pool.
Okay, good, yeah. And then also remember, 22% from a year ago, there were more houses available.
Right.
There were more people that were purchasing.
Right. So same thing. Less inventory, and the interest rates have shaved off some people.
Okay, here's another bullet point. Mortgage rates followed loosely the 10-year Treasury, which has been climbing this week. So, Juana, why are interest rates changing, even though the Fed didn't raise rates last time?
Oh my goodness. Well, there's a lot going on out there, but
Okay.
we'll kind of start with the Treasury because mortgage rates are. There is a relationship, we'll put it that way, between mortgage rates.
They're dating.
And yes,
They have a relationship.
between mortgage rates.
That's their Facebook status. They're in a relationship.
Yes, they are. Okay, so there is a relationship there, but there's also a lot more going on. Of course, there's some uncertainty going on between the volatility in the stock market, what's going on politically with the Speaker of the House. So markets loathe uncertainty. And that's kind of where we are. We are in an uncertain time. And so that makes markets more turbulent. And then that also means more risk. The more risk there is to a lender, the higher you're going to have in the interest rate because they're going to assign a risk premium to everything that's happening.
Yep, that's exactly it. Risk premium. And then remember this, just because you get a 30-year loan does not mean you will the bank is locked in for 30 years to wait to get their money back. Mm-hmm. We know that the average time that people sell their house is right around 10, 11 years.
Right.
So the reason why it's tied or close to the 10-year is because that's the 10-year cost of money. And even though you have a 30-year loan, it's not really a 30-year loan. It's a 30-year amortization. Mm-hmm. Like almost nobody pays off their loan in 30 years. By far, most people sell the house.
Right.
Like it's not even close.
So if there's a 30-year loan, one of three things will happen, right? One, you'll sell the house, so that loan will get paid off way before the 30 years. Two, you'll refinance, so that loan still gets paid off in less than 30 years. And three, you'll just pay off the loan early, which again, it gets paid off in less than 30 years. Very few loans are actually taken from day one to the last day of 30 years.
Okay, here's another quote from the article. Now remember, we're going to tell you why there's no correlation. And then you're going to go, oh my gosh, you're absolutely right. But we're going to talk about this one first because I read this and I was like, okay, this is wrong. At the beginning of this year, the 30-year fixed rate dropped to about 6%. So we're talking January. Remember, because it was like 7%, and then in November, and then by January, it was already down to 6%, causing a brief burst of activity in the spring housing market. Mm-hmm. But it began rising steadily again over the summer, causing sales to drop despite strong demand. The current trend appears to be even higher with the possibility of rates crossing over 8%. Juana, if I had told you, not mentioning interest rates, that sales would start picking up in January, they would pick up through the spring, and then in the summer they would start to drop off, what would you immediately think the cause of that is?
Okay, so they pick up in the spring, drop off in the summer?
Yeah.
Normal?
Oh, that's normal. They always do that. This has nothing to do with interest rates. They're trying to make it that this is all about interest rates, and now that the rates are, higher, that's why it's dropped off. No. Well, that's actually not the case because
the number of transactions has dropped off because there's no inventory.
Because interest rates actually went up from January to May, mm-hmm. but sales went up too, mm-hmm. right? Interest rates went up, number of sales went up, and then the other thing is it says despite strong demand. But how do they know there's strong demand? Because there's not enough inventory to be enough sales.
Right. Well, they know that there's strong demand because of multiple offers on properties. So that makes it a strong demand. Okay,
here's the chart. I'm going to put it up. We are going to tear this chart apart, and we are going to prove unequivocally that the demand for mortgages has nothing to do with interest rates. Mm-hmm. Here's the chart, last 30 years. As you can see, if you go back to 30 years from now, that's the end of that line. So that would be, actually this, it doesn't even, it's, it goes back 30 years. So it goes back into the early 1990s, okay? And you can see that that's the last time demand was this low, right? And you're saying, well, Todd, it's because interest rates are so high. Okay, Juana, just looking at this chart, I want to ask Juana a question. If this is the case to where demand changes with interest rates, right? So if the number of mortgages drops because interest rates go up, and then as interest rates drop, the number of mortgages go up, right? Because that's what their article's saying, right? And that's what all people out there think.
Okay,
Makes
so
sense, right?
It's not a seesaw, so stop it.
Okay, I'm going to give you two scenarios. Year A, interest rates are 6%.
Okay.
Year B, interest rates are 3%. Okay, so double, 6%. And then you have 3%. Which of those years would have the most mortgage demand using that logic? The average person out there would say that.
Okay, I want to know what the SAT score is on the person that you're considering average.
A train leaves Seattle
Exactly.
at 40 miles per hour. Okay.
Exactly. So look, the knee-jerk reaction is that the lower the interest rate, the more mortgage activity you're going to have. However, mortgage activity interest rates have nothing to do with one another, because this is like that math question that you get asked on the SAT, where it says a train going 40 miles an hour leaves Seattle and a train leaving Tulsa leaves at 2 o'clock, and the time difference is 2 hours. When do they get to Des Moines? None of that matters, because you're not none of that information gets you to where you want to be. So that's the same thing with this. The bottom line is interest rates and the number of transactions do not have a relationship in a market where there's insufficient inventory, or even if there is sufficient inventory, there's not necessarily a relationship, because people have to live somewhere. I say this all the time. People have to live somewhere. So if it's time for you to buy, you're going to buy. If it's time for you to sell, you're going to sell. And that's just life. Oh. Interest rates are just part of it. They're not the whole story.
They are actually not correlated at all, and we're going to show you that. It's actually correlated to the number of homes sold every year. This chart has nothing to do with interest rates. This is not an interest rate chart. This is the number of mortgages that were assigned or closed or that were given on a house. 100% what this chart shows, it says it's the lowest in 30 years because interest rates are climbing toward 8%, but it's not. So here's the scenario. Interest rates are 6%. Juana, what were interest rates in 2005?
About the same.
About six, a little over 6.5%, right?
Yeah.
Okay, guys, look at this chart. The very, very high peak, that highest peak you can see on this chart is basically 2005. It's 2005. That was a huge year for sales. A lot of homes, 5.5 million homes sold in 2005.
Right. So mortgage demand is correlated to the number of transactions. It's not correlated to interest rates. And number of transactions is a whole different ball of wax. People purchase for all kinds of reasons. In that particular environment, people were purchasing because they could, because they didn't have to fog up a mirror in order to get a mortgage. And so there was a lot of activity, a lot of transactions, and that's why that's showing that number of mortgages, because everybody was getting a mortgage.
Now go on the same chart, go look over there at 2020, okay? You can see it dipped down and went back up, but you can see right at where it's like 300, that little 300 line. Remember, in 2020, at the end of 2020 and most of 2021, interest rates were 3%, right?
So you would think that with free money, there would be a lot of activity, but there wasn't.
So why is it that with 3% interest rates, which we just had a couple years ago, not even 2 years ago, we have less demand for mortgages than 2005 when we had, as a matter of fact, you can go all the way back from basically 2009 all the way back to almost 1998. And interest rates were way higher than they are now. And there was far more demand, far more. Like it's saying now it's 125 and back then it was 500. There was 4 times more demand for interest rates when they were at 6%. Has nothing to do with interest rates.
Right.
It's this chart, even though it's the number of mortgages that were done, it's basically the number of homes that were sold, right?
Right.
This is an important lesson in all other things being held equal. you have to hold everything else being equal. You would have to, first of all, equalize these markets for total home sales. So you'd have to like subtract out the number of percentage difference in home sales, right? Then you'd have to take all the cash buyers out, right? Because there weren't a lot of cash buyers in 2005. Guess where there were a lot of cash buyers? Look at 2010. See how it tanked and it's almost the lowest it was? From 2010 to about 2015, we were seeing probably half of all properties being purchased cash because they were cheap. So there weren't a lot of people demanding mortgages because they didn't need them.
Well, number one, because they didn't need them, and number two, because sometimes the purchase price was below the level that lenders would lend at. So lenders have rules as far as when it's no longer profitable for them to issue a mortgage, because there is a cost for them to issue a mortgage. And so at the time, if you were looking at a mortgage of less than $70,000, it wasn't going to happen. They weren't going to give you one, not because you were unworthy, but because there wasn't sufficient profit margin in it for them for a $70,000 mortgage.
In 2011, interest rates were about 4%. They were 4%. And you could see that they're not much, the demand, that little line, is about the same as it was back then. So we have 4% interest rates, 7.5% interest rates. These should not show the same number. It's because you've stripped out a lot of sales because people were buying cash in 2011.
Right.
So all of a sudden, so here we are where they put out this article with the headline about mortgage interest rates and the lowest demand. The bottom line is there's not enough homes available to purchase. Even if everyone wanted to purchase all the homes and get loans on them, they still would never reach the numbers of 2005.
Right. You know, the thing that nobody's really talking about, and I think it's worth having a discussion, is HELOCs and seconds.
Okay.
So this is not a conversation that I've heard out there, and I think this is something that we can discuss real quick. Now, if interest rates, I like round numbers because it's easy math. If interest rates are 8%, a second is going to be what, 10, 11%?
Yep.
A HELOC is going to be what, 12 to 14, 15%?
Probably.
So that's a really interesting conversation to have. So as people are locked into their homes because they don't want to go out there and buy something else at a higher interest rate, they're also kind of in this position where they can't get a second or a HELOC to maybe do renovations to their present home. And I think that's going to come back and bite us later down the road as the housing stock ages and deteriorates. And at some point, these people will sell their homes. And what will that product be like? I think that's something to really consider.
Interest rates could be 3% right now, and this chart wouldn't look much different. There wouldn't, if people don't sell their houses, there's not going to be enough houses to purchase.
Right.
And it's really not interest rates that are why sales are slow. It's the number of homes available for purchase is historically significantly lower than it was, just like what this chart shows. This chart basically is showing the, inventory level compared to the number of people getting mortgages. That's all it is.
Right. And to give you an idea of how tight the housing market is, I had the opportunity to listen to a presentation from a luxury home builder. And what they're doing is they are doing this less than transparent lottery for new homes. Now, these are not new homes that really most people are going to be looking for, right? These new homes start at about 1.3 million. Okay.
Which in Vegas is a lot. Okay. Maybe if you're in San Diego, you're like, that's right. The dump down the street's 1.3 million.
Yeah. So these are, these are pricey homes. So what they're doing is they're taking an interest list, but that interest list is more than just putting your name and email address down. It's really a whole slew of questions about your financial capacity to perform. And then they're taking all of those people and they're evaluating their capacity to perform, their net worth, whether they're paying cash, getting a loan, what kind of loan would they get, how much down payment. And then they're just picking the cream and they are offering them the opportunity to purchase one of the 6 homes being offered for sale each month.
So they're not just random, because traditionally you put your name in a hat and they pull the number out.
No.
No, they're not doing that. They're saying, we will select you based on all this information you felt. If you want to pay cash, you're going to be one of the 6. If you say, oh, here's a bank statement, I've got the money in the bank.
Right.
I just sold a house somewhere else and I've got all the cash. Or
Right. So they're looking at basically fully financially qualifying these buyers before they're even allowed to take a look at the offering of the homes.
my grandma would have showed up with boxes of the S&H green stamps saying, here's S&H green stamps, I want to buy that house.
This gives you an idea of how tight the housing market is. When a builder can do that, when a builder can say, okay, look, I've got these $1.3 million to $1.7 million homes. We're only selling 6 of them a month. And all these people who might be interested in buying them, basically, to your point, Todd, if you're paying cash, you might have an opportunity at it, because if we have more than 6 of you paying cash, not everybody's going to get a house. So then they have other criteria. So one of the other criteria, for example, is they have multiple floor plans. So they want to make sure that they sell several of each of the floor plans in each phase, because they want to balance out the workload for the crews. So they've got all kinds of criteria. It's like bistro math. But the point of this is how selective the seller gets to be regarding what buyer they're going to allow the opportunity to purchase a home, versus the way it generally works in the marketplace, right, where buyers get their choice and the seller is grateful to sell their product. That's not the case with builders, and that's simply a measure of the tight housing market and the control that builders have at this point.
It's not going to get better if home builders don't start building like crazy, and they are not going to.
No.
This is going to be a worse problem going forward. There are no foreclosures coming. They're not coming. There are just no mortgage defaults. People aren't in default of their 3% mortgage. Maybe if we have 5 more years of 7-8% interest rates, then some of these people at some point in the future, if there's some economic catastrophe that happens, may start to get foreclosed. But we're not seeing that. So,
right.
Yeah.
So I just wanted to share that with you, because I think it's so telling of what it's like in the new home housing market. Now, and if you're asking, well, why are they only bringing 6 homes to market every month? Because they get to do price increases the next month, and because they're trying to meter out their production, because they have limited crews to be able to put these homes up.
Okay.
So there, hopefully I answered your questions. If I didn't, please put your questions in the comments. I would love the opportunity to answer them. Remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.